Welcome back to Passing Notes with Chaz Guinn. I am your host, Hayes Brumbeloe. It's good to have you back, Mr. Guinn. How are you?
I think we talked about this a few episodes ago. I mean, hockey, basketball, baseball, football. Even if you're not a sports person, you can put up with some of the fun stuff that we're watching right now, man. This is great.
I absolutely love Saturdays and Sundays right now.
Wives, maybe not so much.
Oh, the honey-do list never ends.
Ooh, keeps just piling on. Hey, Saturday, I need you to
Bust out the ladder. I've got
And then
19 things
Sunday,
for you.
we need the lights down.
And now the lights are going up. I don't crawl on my roof to put on lights.
You send like the drone up. You
No.
just hit the drone.
No, I've got a guy named Cole who's awesome.
Ooh.
Cole, you're the man.
Shout out.
Shout out to Cole. Appreciate you putting the lights up. Not trying to die. It's good to be back. What is this, episode 12?
12.
Ripping through these things. These have been fun. These have been a lot of fun. Last couple have been a lot of fun. Today's episode, we've talked about it before. Offense, defense, special teams. But before we jump into that, I want to talk about tails. We've talked about when Revolve Capital takes down a portfolio, we proactively eliminate tails. First off, let's talk about what tails are, and let's talk about how Revolve Capital eliminates it on the front end.
A tail sounds exactly what it sounds like, which is you get to the end of a portfolio, and that's a tail. It could be a 10 loan portfolio or a 1,000 loan portfolio, and you have the last 50 houses, last 100 properties that have yet to sell.
Sure.
Those are called the tail of the portfolio.
Yep.
Okay, so usually that's going to be a vacant property, a rule property, a litigated property, a property that has missing documentation that
Not
is
a sexy property.
something that's causing the box to be checked, that it's not allowing it to churn over in a quick
Right.
fashion. So it kind of lingers in the portfolio. And it becomes a kind of a house that starts to not rot on your books, but hang on your books for longer than you originally modeled
Right.
and expected to hold it onto. So it becomes a tail, straight out. For us, we mitigate those tails from the onset. We know vacancies, rules, mobiles, manufactureds, litigated, missing docs.
Correct.
We price that in from the due diligence portion, but we also look to litigate those files first.
Right.
Not last. That's the key here. So if they're identified and you know that they're identified because you have systems that we teach, that we put you in terms of our educational coursing, we show you how to identify these, how to segment them and bucketize them, and how to liquidate them first versus last.
Exactly.
Because if you mitigate your tails first, then you're leaving yourself the cream of the crop to manage through the portfolio.
Right.
Cream of the crop meaning NPLs that have turned to RPLs and you're now seasoning them up.
Right.
NPLs that are in the later stages of foreclosure and you finish the foreclosure out and convert those to REOs,
Right.
to rentals, to fix and flips. Or they're a spotty payer, meaning they've made 5 to 6 payments out of the course of a 12-month calendar year, and you now correct those payments to get them on time, and they no longer become spotty, and they're now a consistent on-time paying RPL.
There you go.
Again, that could be held to then rinse and repeat.
100%.
These are all assets you would want to be left with versus assets you want to just be liquidating first and then be left with the tail at the end.
Right.
Mitigate your tails from the onset and then leave yourself assets you want to manage at kind of the bulk tail of the portfolio.
100%. So with that being said, let's talk about Revolve Capital's strategy in regards to offense, defense, special teams. So let's talk about offense first. Let's talk about the strategy behind the offense. What is it?
So for any non-football folks out there, is that we have complementary departments that all help each other.
Right.
Right. So when one department has a weakness, the other department has a strength.
Right.
And so they all complement one another. So back to the kind of the sports analogy is that we have an offensive side of our strategy, a defensive side of our strategy, and a special teams part. What that means is we have a large clientele of folks that buy properties from us nationally, and there are folks that we also have abroad, located across the globe. Okay, folks from Australia to Switzerland are acquiring assets from us here at Revolve. That is the offensive side of our strategy, so that if the foreclosure could be a year out. The asset could not, maybe it potentially doesn't show a modification probability that's high enough for us. We have an internal system that kind of deems why something is either held or kept. Let's say that we push something into the sorry, I said held or kept, or held or liquidated portion. Let's say we push it into the liquidation portion of the side. If it's in the liquidation portion, we know that there's money being left on the table, but hopefully that's enough room for everyone listening to go out and make money on our deal flow. And be able to come back and rinse and repeat that opportunity. Okay. So we always say one man's trash, another man's treasure. So we may be able, on the offensive side, we rinse and repeat a portion of our portfolio inside of 120 days from acquisition. There could be things we miss in the service transfer. There could be hands that were raised from the homeowner's perspective that we didn't see, wanted a mod, but when we sell it to new investor, they now have the opportunity to scoop that mod up. Good for you. We made our margin. You hopefully are going to make a bigger margin. Hopefully you take those winnings, come back, rinse and repeat again. That's the offensive side of our strategy. We hope folks out there learn how to trade and learn how to recycle through their notes just as much as they learn how to asset manage their notes. Okay? So offensive side, rinse and repeat is a wholesale kind of model. The defensive side is converting NPLs into RPLs. We talk about this a lot, that we allow hundreds of investors listening to be able to have the opportunity through their licensed servicer to get folks back on track. Stay in their homes. Don't break up the family. The folks are saying they have the economic means to stay and pay. We'll get them into a repayment structure that allows that opportunity to come to reality. Okay, it's not that hard. Chances are you bought the file at a discount. You have the room to discount the balance. You have the ability to get them to repay
and work within their means.
Your model. Now, if they don't have the economic means, then this is another strategy we would teach you. Right? That means a mod can't be had. It's vacant. They don't have a job. They're not willing to stay and pay. Right? That negates what we're talking about. What we're talking about is the defensive strategy to convert an NPL to an RPL and season up the cash flow. You and I were just talking to a couple of clients that were showing us their strategy. They had like a 50-50 play. Hold to rental or wholesale. And we said, where's the cash flow side of that business? Don't you have to pay pref on your fund? Don't you have overhead? Don't you have expenses? So the only way that you're able to offset those expenses is through sales. But where's your cash flow? So you have income coming in to help offsetting all your outbound expenses, right? So we teach the defensive side here as well. NPL to RPL, create yourself cash flow. Spotty pay to RPL, create yourself cash flow. Cash for key to deed in lieu to turning it into a rental, create cash flow. Okay? That's the defensive side. I'm sure you're no stranger to seeing how strong the market's been over the last few years. Been dang strong. It's been on a run. 2019 and 20, we thought the pandemic was going to turn the market upside down and cause the residential market to go belly up and say, look, the terror that it's kind of been on in terms of HPA, home price appreciation, is going to slow. And it went the complete opposite. 2020, it went on a tear. 2021, it went on a tear. How much appreciation did you gain in those years?
It was a good year.
So we know that the market in 2023 and 24 will look nothing like it did in 21 and 22. And 20 for all that matters. That being said, the special team side is we saw later stage foreclosures, properties that were vacant that we were able to get the real estate back on. We were able to do some minor rehabilitation to get the property into a sellable condition. Put a for sale sign, rinse and repeat it, and sold the asset. That's the special teams side of our business. Do we think that there's still absolute a market out there? Like my neighbor just put a for sale sign and I was like, dude, this is a tough market to put a for sale sign in, right? He's a doctor, curious if he's going to go to another state, curious if he's moving his practice, not sure, but he's seeing something. He's clearly seeing still a demand in this market because the supply is so dang low. The supply is still not there.
You're going to sell high and you're going to buy high, though.
You are. So we still see, though, the opportunity where folks are still saying, look, the supply ain't there to kind of keep up with the demand. However, there's still so much low supply, people will still overpay. People will still buy into this market. even whether how silly you and I both think that is or not, right? But the special teams can still be exercised by portfolio managers listening, right? You still can have a offense, defense, and now this special team says, look, there's still going to be vacancies. There's still going to be low-hanging fruit in terms of the foreclosure process. Managers like us still actively push deal flow along so that it goes from the 20 to the 50 to the other 20.
Right.
And now we do sell deals that are at the 20
in the red zone.
In the red zone, ready for you to score.
Right.
I still think that there's valid opportunity, huge opportunity in 23 and 24 for folks to exercise the special teams. 100%. Right.
The amount that's coming to shore, I think there's a lot of play there.
But if you're hedged in only one of those avenues, only one of those three, then you're kind of narrowing yourself off to the rinse and repeating opportunity 100%. We teach. 100%. We get into the minutia of what you should be focusing on from an Excel basis.
Right.
When you look at the data, there is ways to filter and funnel out an Excel sheet. If you're looking at 50 properties, how do you get to 5 that you really like?
Sure.
Right? It could be a state filter, it could be a location filter, it can be an occupancy filter, it can be a value filter, it can be an interest rate filter, it can be a maturity date filter, it could be a servicing comment, what's happening with the homeowner filter.
Right.
These are just a few deals where we say, look, take a 500 loan pool and make it into the top 50 you like.
Right.
And take those top 50 and make it into 5 you like.
Oh, but you're going to love them.
How do you do that?
Right.
Because you narrow in on what's going to allow me the best opportunity to offense, defense, and special teams, my 100%. Strategy, right?
And they can learn that through the taking notes with Revolve Capital.
We want to get into a far more minutia than we are today. I'm kind of talking.
This is high level. This is high level. But at the end of the day, I mean, the audience can obviously go to Revolve Capital. They can become a member of Revolve Plus, and then they can turn around and jump right into our educational series, because that's when we dive in deep. We go in real deep.
I mean, Hayes, 2011 through 14, the market was still falling in terms of values, and big, large sellers were still carving off tranches of large volumes of these assets that we were scooping up on a consistent basis.
Right.
And so the ability to special team the portfolio was limited.
Right.
The market was still falling.
Right.
You didn't want to still finish the foreclosure out and do a bunch of resales when you didn't know how far low the market was going to go.
Exactly.
So you kind of did the offensive side of the business was far more prevalent in our strategy because the inventory was meeting up with the demand. We had enough supply.
Sure.
We didn't want to sit there and say, let's go do other strategies that are going to take us away from the high turnover of volume we're seeing.
Right.
Right? But now, as volume is still heavily there, it's now, what are you doing more with the assets to bring true value to the portfolio? And this is why we're like, look, hedge yourself.
Yep.
Hedge, learn. More importantly, remain a student, we always talk about, but not to beat the dead horse there. And that strategy is learn how we're doing different things to offset your fund, to offset your income, to offset how you're paying investors back. These are all things we want to get into the minutia on as we grow our relationship.
Yeah, I agree with you 100%. And that goes kind of hand in hand with, that's what we're doing on the Revolve Capital level. From a buyer standpoint, what are some of the strategies that they can implement from a granular level from their side? Looking at the offense, defense, and special teams. What are some of the things they should consider or implement into their growth strategy?
You see a lot of data, and the data tells you that the homeowner hasn't made a payment in 2 years. You're immediately bucketing that file into a non-paying asset, and you're going to throw it into foreclosure, and you're going to consistently push the foreclosure until you get the real estate back through the foreclosure action being completed.
Right.
However, there's an occupant, there's a story, and the loan doesn't mature until another 27 years from now.
Right.
However, if you could get that person to start repaying on their original terms or close to those terms, although they may not be able to reinstate, could you take those reinstatement figures and throw them to the back of the loan so that person can start paying and stay wherever they are, so that foreclosure and you and the homeowner don't have to get into a potential litigious battle?
Sure.
So what we try and teach is when you look at the data and you know that it's an occupied file, give yourself a rate and a probability for the chances to get them to reperform.
Yeah.
If that reperform probability is low, then you may need to use foreclosure to surface a result with that homeowner.
Right.
But chances are the foreclosure strategy is going to be costly and timely.
Sure.
So you should try and focus on, how do I cash flow the file before I have to just consistently expense money on this file until I get the property back through real estate, which may take another 18 months.
Right.
So I'm going to have zero water coming from this rock for another 18 months. How best can I squeeze it so I get something coming from it than nothing?
Sure.
So we try and teach strategies of, look, foreclosure usually is inevitable, and it's usually a necessary evil. However, if there's an alternative to your strategy, which is to get it to cash flowing, because you may have
Stay
bought
and
that
pay.
NPL at a steep discount, but that now, if you get them to reperform, that steep discounted investment is worth double if it consistently repays.
Right.
Usually you don't know that. You're going for a rental play. That's why you're foreclosing. You want to get the real estate back, but you have no idea how long that may or may not take you to get it through.
Sure.
And as you can see, the moratoriums have been lifted in the foreclosure processes, and the court systems are backlogged.
Yeah.
Right? I don't see the Nile River opening up for clear pathways anytime soon. It's only going to remain backlogged as we
Right.
head into 23, and more foreclosures
Pure bottleneck.
and more delinquencies continue to uptick.
Right.
Right?
That's why we talked about that wave that's coming.
So I'm like, look, hey, buyer. Okay, I know you're newer. I know you've bought 5 assets before, 12 assets before, right? Have you bought bulk? Because buying bulk gives you a deeper discount.
Sure.
But through that deeper discount creates more risk for you if you don't have a clear-cut strategy.
100%.
How do you spot the strategy and the data from the moment you purchase, so you already know what outcomes, timelines, and turnover you're
You
expecting?
know what your moves are.
I don't see that. I don't see that a ton. I
Right.
see that just by a few investors. Every 10, I see it by 2 or 3. 7 of them are like, oh, I'm not really sure. The strategy here. And I'm like, you didn't think, I know you want 10,
Right.
but what happens when your first 3 become home runs? Good job. But the ones you expected to be singles and doubles are now losses because you didn't expect that. You expected that NPL to turn to RPL, and then they stopped answering your calls and your door knocks altogether.
Right.
And now foreclosure has to be had. But you didn't create a network underneath you to recycle that file through a sale, and now you're left with holding onto the file through foreclosure, which is costly and timely.
Sure.
Something you didn't plan for.
Right.
So this is why we're saying, hey, look, you don't need to have your capital tied up in this business for 18 months in files you didn't plan to be in for 18 months.
100%. Yeah.
This is the things that we're teaching.
And
right?
that's why the educational series is so valuable.
Check it out.
So valuable. And you can go to Revolve Capital, check out Revolve Plus, become a member. That gives you access to taking notes with Revolve Capital, where Chaz is going to be leading a lot of the educational series, really diving deeper, getting granular with the strategy for managing this entire asset class. He's been in it for a long time, and you'll benefit from it. But like always, we appreciate you stopping by. Today was a great episode. Thank you for sharing the knowledge. And we look forward to seeing you next time. Cheers.